A journey of 1,000 miles begins with a single step. Lao Tzu. You need to take that step. If you have not done it, that is committing yourself 10 to 15 minutes a day to learn how to read stock charts. When it comes to your financial future, what is more important than you learning the skill set of how to read stock charts? I'm talking to lots of students every day, well, would-be students, people who want to sign up and take the Advanced Market Mastery course. You'll see a link in your show notes. I interview personally everyone to consider whether or not they should be taking the course. And I keep talking to folks and asking them, are you following the weekly vertical crossovers? Are you practice trading these things to see how they work? Because they are absolutely amazing. And most of the people that we're signing up at this point, of course, have been following us for quite a while, been waiting for the Advanced Market Mastery course. But I do have people who've come to us recently who've listened a little bit, but they've been doing no practice trading. And my friends, if you're not doing that, you're just wasting so much of your time and energy. 10 to 15 minutes a day. That also means doing the practice trades. We've had 11. We're in the 12th one right now throughout the course of the year. All of them have been successful. We're hoping gold is going to be that way. We're going to get to that in just a minute. Let's look at the charts. We see stocks are mixed. Bonds and gold are up a little bit. Gold's up a little bit. Bonds are up some too. And we see Bitcoin, real estate, and oil, black gold as I call it, down. Now let's jump into these charts. Do you notice that I'm using the new charts? I'm actually using TC2000's charts. And check it out, engineers. What do we have here for you? We have the 195-minute chart, no longer the 4 hours. This is the way I set this up a while back. Just the old legacy chart we had been using for our freestockcharts.com folks had the 4 hour. These, of course, this is the newest version of TC2000, and it is fabulous. So let's talk about what we see happening this week so far on the S&P. Down a little bit for the day, 0.42%. We have a red spinning top. That is a solid red spinning top. Last week it was an open red. That meant indecision tending down. But again, remember the open box Heikin-Ashi candlesticks are really just a slow down in the up movement. This is showing us a more serious slowdown, and we see price sitting right there on our weekly trend line. Derivative oscillator losing momentum. Price percent oscillator nonetheless is going up. That's a good sign for continued movement as far as the weekly goes. But again, we're paying attention to what's going on with price. It's moved below the 2-day, sitting right there on the weekly trend line. Now, I got to get myself adjusted to where I change all these things because old habits die hard. Now, remember the latest 2-day chart that ended on Tuesday. This is the first day of the latest 2-day candle. Price percent oscillator still heading down a little bit. Green up candle forming. Going now again, we had moved down and set on the 2-day. It's moving up a little bit, but that derivative oscillator still losing momentum. Price percent oscillator still heading down. So still some weakness there. Go to the 195-minute. I'll probably still call it the 4-hour chart. Because maybe I should just say half day. That's what I'll try to do. The half-day chart. Flat as far as the price percent oscillator goes. Derivative oscillators turn positive up in the morning, pull back in the afternoon. So again, keep your eye on the price, particularly on that weekly chart. And again, weakening in the 2-day, but hasn't crossed over going down. Will it bounce and move back up? It may. We'll continue to watch, see what there is to see. For those of you who have ridden this up so far, did you take profits at either the green candle back on ending the 5th of June or the open box red candlestick back on sometime during the week ending the 12th of June? Did you, and again, these are different strategies you can use. You can use all sorts of strategies for ending your trade in bifurcation or trifurcation. In other words, you can set, we talk about this and have a great training on it. In fact, I'm going to mark my notes to put it out again tomorrow. It is the secret of profit and loss bands. The special training we have for you today is about looking back. It is about, and in fact, it is entitled, I put it here in my show notes, Backing Away to See What's Really Going On. That is what you should be doing on Wednesday night. If you were listening to this, I'm recording it Wednesday afternoon for Thursday. Wednesday nights, I spoke about this yesterday, that's when you forget about everything you've seen on the charts, take a breath, go to your weekly chart and see what the weekly charts are telling you on all the ETFs or stocks you are following. You do that every Wednesday. You put that in your notes and you pay attention to what the weekly charts in and of themselves are telling you. Remember, everything that we do revolves around the weekly vertical crossovers because they are the big trend that have worked 11 times out of 11 this year. They worked, gosh, I don't remember how many times. I think we had one or two that we would have considered failures last year out of 20-something. So you're talking a 95%. I mean, again, 95% accuracy rate. Now, not making any guarantees. We're not a stock calling service. You don't pay us. We don't give financial advice or trading advice. We're an education firm. But I want you to be educated and I want you to practice what we do. So that's where we are on the S&P 500. Let's go to the Qs, up for the day 0.32%. Now on the Qs, we have a red open box candle. Last week, unlike the S&P 500 that was a red open box candle, it was a green candle going up, actually hit the highest high. So as we see things slowing down, we see that we have dropped below the 2-day trend line, sitting just there above the weekly, but look at that price percent oscillator still going up, derivative oscillator losing a little bit of momentum. Go to the 2-day chart. It again is about flat. We do see the first day of the latest 2-day candle trying to move up, not hitting the high previously, but not off that awfully that far off. Derivative oscillator still devolving. So pay close attention to if and when there's a crossover on that 2-day chart that is going to blow a whistle for you to, and again, there are no hard and fast rules when you pull your trade, but when that 2-day chart crosses over going down, if you've stayed in that long, you need to have some serious consideration as to pulling your trade at that point, or at least selling 2 or 3 of your profit loss bands. And again, going to put out that profit and loss band training tomorrow. We go to the, I'm calling it half-day chart now. Up in the morning, slow down in the afternoon, like we said, 0.32%. Price percent oscillator was going up at a much steeper angle in the morning. That leveled off in the afternoon. Derivative oscillator popped over to positive. So again, that is a short chart crossover, vertical crossover. We don't get real excited about those, but that's not a bad sign. And again, could be a potential jumping in point, but we find they get so dangerous. So why take chances? Why not just use weekly vertical crossovers? They tend to work so very well. Look at it. You can see it on the 4-hour chart, how beautiful it has been. And you've had the 4-hour chart cross back and forth, back and forth, back and forth. This is like the, 4th or 5th time that it's crossed over going up. When things start getting long in the tooth, because what does go up does come down. So be careful. Use those weekly vertical crossovers to your advantage in your practice trading. Now we leave stocks, go to bonds. Bonds up for the day, 0.41%. What do we see as far as our weekly candle? Green open box spinning top. Last week was a slowdown in the down movement indecision. This week we've got a long wick on top, little wick on the bottom, but is a green open box candle. But check out the price percent oscillator still moving down, derivative oscillator. For those who aren't familiar with what we do and you're like, why is this all so confusing? You say in one way it's going up, in another way it's going down. We are balancing these things off priorities. The main priority is what happens with our price percent oscillator. It is our main indicator. It was going down at a steeper angle before this week. It has slowed down in that descent. Derivative oscillator, which is a triple smooth version of the relative strength index, continuing to gain momentum. Remember, it shows us overbought and oversold conditions. That is a leading indicator as opposed to a lagging indicator of the price percent oscillator. These Heikin-Ashi candlesticks, we put that training out yesterday at the end of the video. hope that those of you interested in that took that. When you study Heikin Ashi candlesticks, you understand what they are showing you. They are not dispositive. What is dispositive, what we like to see, is when the Heikin Ashi are telling us the same thing that the price percent oscillator is. When things start getting counter to each other, then we pay attention to that. It gives us some pause for concern to look deeper. Does that make sense? So that's why you'll hear me say, oh, this looks bad, oh, this looks good. You have to remember the priority of what we look at. What we look at first, price percent oscillator. Then we compare derivative oscillator, Heikin Ashi candlesticks. Are they complementing what's going on with the price percent oscillator? If so, great. If they're not, then we pay attention to what's going on here and a little bit of confusion as far as movement goes. We look at the trend lines. We see that we are below the trend line. It's a down trend. We're getting close to it. And again, those are telling us things also. Excuse me. And the more you do this, the more you will, and particularly with specific charts, the more you'll learn the personality and how important all those different things are. That's why whenever anybody says, I'm going to automate what you guys do here, we're going to set up a computer program. Engineers, that's not the way this works. If that's what you think you can do, you will be sorely mistaken. That is not how things work in this world. They don't work that way in the trading world. Now, we're going to go, and I'm trying to figure out what's going on with this 2-day trend line. It just is not a good line. We got to find out a better way to draw that. Maybe over the next couple of days, we'll find a better 2-day trend line. Not much of one now. So when we look, we see that the first day of this latest 2-day candle, red, solid red candle, not a big one with a little wick on the bottom, but that's what we have forming first day. We see the price percent oscillators about flat, maybe heading down a little bit. Derivative oscillator losing downward momentum. So all that is coming from the fact that we had 4 days of up movement, but stalling out on the weekly trend line, which is good to see for continued down movement. So we're going to pay attention to that. We do have a flattening of the price percent oscillator. Gives us some warning. We're way, way low on that thing. Can it go lower? It can. It has more room to go down. Not a whole lot. Well, I mean, it can go down some more. We're just going to watch, wait, and see what it shows us. So again, we're paying attention to those things. Now, this is interesting. We can see that we had a big down move on the charts on Tuesday morning, and then we saw that things have just sort of stalled there on the 4-hour chart. Not enough energy to cross over, which is interesting on the price percent oscillator. Derivative oscillator has flipped because of all the energy of that big strong down move on Tuesday morning. So we'll continue to watch, see what there is to see there, and if bonds are going to heat up in more down moves. Lastly, on our big 4 charts, before we get to those other 3 you guys are interested in, what's going on with gold? I just have really been wanting gold to just rocket down. What is making me continue to have hope? It is that we see the price percent oscillator pulling away from the red signal line. Derivative oscillator this week has gone more negative, okay? We do see the weekly chart pulling away. What we've seen, though, going into the second week after the weekly vertical crossover is a sideways slide. So that's all right as long as we don't have some significant up movement. Look at the 2-day chart. Price percent oscillator also still going down, vitally important. Now, derivative oscillator losing downward momentum. You know, we'd like to see it gaining downward momentum like it was, particularly the 27th through the 8th. That's the 27th of May through the 8th of June. But then we had that pop-up for 4 days, and now that's hopefully devolving. This is the first day of the latest 2-day candle. We'll see how things shape up on Thursday. But again, all important price percent oscillator still going down. Derivative oscillator next in importance, along with the Heikin Ashi candlesticks. Again, giving us some mixed signals. But that price percent oscillator overrules everything along with a weekly chart. Go to the half-day chart. Was hoping that was going to cross over. What's it doing? Sliding sideways. Hasn't recovered where it went down, of course, with that big move that a lot of us got excited about starting the week off on Monday. I hope to see that resume. I don't want to see it bottom out here and then start perking up again like it did back on the 8th through the 12th. Now, when you look at gold, if you look at the range that gold has been in, okay, gold's been in the range of 158 to 164. And if it pops above that 164, that spells some problems for us. If it goes below the 158, we're going to feel really, really good about continued down movement. Now, those of you who hadn't been with us a while, you're like, why would anybody want gold to go down? Because, my friends, we're playing puts on that. There's not really a good inverse gold fund. They are not liquid, so we don't get into inverse funds with gold. But there's a lot of us who are practice trading gold on puts right now, and we want to see that be successful. If it's not successful, it'll be the first weekly vertical crossover that's not worked for us this year, and I want them all to work because they almost always do 95% of the time, is what our experience in the recent past has been. Not just the recent past, it's what our experience has been for a while. So again, that's the magic of the weekly vertical crossover. Folks, we have covered our big four. I'm about to get into 3 more charts. I try to keep it at 10 to 15 minutes for this initial training. Like I promised, we are done with those charts. If that's all you're interested in, you may go now. Thank you so much for being with us. If you have not signed up for, have not found out what our training is all about, the accelerated market mastery course, we are doing interviews for those. I'm spending a lot of my mornings, about 30 minutes a call, getting to know folks, seeing if the training is right for them. If you want to find out more about the training before you set up an interview, would you please watch the video? It'll be in your show notes today, whether you're listening to us on iTunes, whether you are watching the YouTube video or you're getting our emails. You'll see links to the Advanced Market Mastery video. Please watch that. It tells you all about how we spend the first month on charting, the second month on options, the third month on building your own virtual private wealth fund, which is like a little mini hedge fund that you practice, trade, and learn to manage. So that's really what we drive everything to. And again, 10 to 15 minutes a day is what it takes to spend the time with us to master these things. And of course, that 3-month course, and it's followed by 3 months of question and answer. Once a month, we get everybody together and we deal with your issues. And again, help you work your way through charting, options, and setting up that virtual personal wealth fund that you practice trade to learn how to manage it. Now, that's where we are as we end the day with those first 4 big charts. Now we go into Bitcoin. Bitcoin down 0.70% for the day. When we look at the price percent oscillator, we can see it just steadily losing energy. Bitcoin peaked at $9,978.93. Remember, it hit a high back before the crash of $10,090, so it got pretty darn close. Now, though, it tends to be devolving. It's $9,394.84. So we've got a red down candle, the first one we've seen in a while, going all the way back. And again, that was just sort of that was just a digestion move, it looks like there, back on the week ending the 17th of April. So as we look at things, we do see price percent oscillator continuing to lose momentum, derivative oscillator losing upward momentum. Go to the 2-day chart. Of course, it crossed over going down as we talked about yesterday on Tuesday. And on Wednesday, first day of the latest 2-day candle, derivative oscillator trying to turn negative. We're not going to call it yet because the candle doesn't finish drawing until tomorrow. But again, appears to be adding more downward momentum to that. Pay attention to that. That should be a real sign that these up moves for the time being have slowed significantly. If you're in a practice trade on that, you need to be careful with yourself. You've had 1, 2, 3 days of very strong down movement, popped up and then sort of died on that 4-hour chart. So careful with Bitcoin. Might be a time to pull that practice trade and particularly pay attention to perhaps a 2-day recross at some point, and hopefully not too distant future. What about real estate? Down for the day 1.45%. We see the price percent oscillator still spiking up. I mean, it's just going through the roof, even with a week that's starting off rather slack. Very interesting. But remember, we had that weekly vertical crossover in real estate back on the 29th. It's been 29th of May. It's been very, very good to you. Somewhere the jumping in point of, well, you know what? This really, I don't know. I've noticed on the new chart now, it doesn't give me, it's not giving, I mean, the other one, if you guys remember, it always gave me the last. It's not giving me the last on Friday. Am I missing that somewhere? Was it 70? No. Maybe it was 76.89. Maybe that was the last. Let's see. Was that 70? No. Well, I'm guessing the last must have been that. That must be the number at the top. 70, well, over here, right at the top. 76.89. Somewhere up to a high of 86.80. So yeah, I think that's what that is. That must have been the last. So yeah, that has been really good for us so far. And again, I've been coming to you guys with the legacy chart. Now we've switched over to the TC2000. So a bit of a learning curve for me also. Heck, I've used those charts for all the years we've been here. So sort of a sweet goodbye to them. Well, what do we see going on the weekly here on real estate? Like we said, a weak Heikin-Ashi candlestick, but still that price percent oscillator spiking up. 2-day peaked back on Monday, the 8th of June, and then we see things sort of devolving and trying to gain a little more energy. We see that the 2-day is still positive, as is the weekly. We go to the half-day. That is where we see sort of that momentum slowing down and starting to roll back over. So pay attention to that. And again, let the bigger charts continue to guide you, but do pay attention to what's going on that 4-hour chart if you're in that practice trade on real estate. We still have the weekly looking strong, 2-day looking not as strong, flat, but not going down at this point on the price percent oscillator, which is the most important thing. Heikin-Ashi trying to gain some upward momentum. So pay close attention to that 2-day chart tomorrow, Thursday, at the close of the market when it finishes drawing. Lastly, black gold. We go to oil. Now, if we look at the weekly chart, which is where we always start, it is heading up, trying to cross over down for the day 1.30%. So we've seen oil go up for 4 weeks, and this latest week is really showing pretty much a doji, indecision tending down. Not crossed over yet, that derivative oscillator gaining momentum, so maybe in the not too distant future we'll have a crossover going up. If we track back in gold, it is somewhat sloppy here. Do you see how sloppy gold is? You guys asked me to track gold. One reason I wasn't super excited about tracking gold, I wasn't super excited about tracking oil was because of how sloppy the weekly vertical crossovers were. These aren't the kind of charts I typically track. The reason I tracked it is because you guys asked me to do it. I don't like sloppy charts. I don't like sloppy weekly vertical crossovers. I like them nice and clean, like gold, like the NASDAQ 100, like 20-year bonds, and like the S&P 500. But maybe this will be a nice clean crossover going up since it's bottomed out so much, and maybe gold will get back to not being nearly as sloppy as it has been in the past. These kinds of charts don't excite me, but so many of you asked me to track gold, I gave in and said I would do it. But do you understand why I don't get excited about it? That's why. 2-day chart, again, we saw the huge crush down. It crossed over back on Friday the 15th, the 2-day chart did of May. And of course, you can see how it's tracked up a little bit during that time period. Nothing too exciting there. What was exciting was gold crashing, and we'll see if gold does indeed gain its way back. Half-day chart, we just see it still negative, and again, sort of rocking back and forth. Derivative oscillator losing downward momentum, turned green, and we'll continue to watch. Primarily what we're waiting for is that weekly vertical crossover going up. Folks, that's where we are as we end the day. Don't miss out if you are interested in really accelerating your market mastery by watching the video. You'll see at the end of the video and in your show notes, watch the video, determine whether or not you think you have what it takes to take that training course. Space is limited, time is limited. I'll spend about 30 minutes with you on the phone talking with you about it to see if you've got the right attitude and understand what it is we're trying to do on this. And I feel like it will help you, not just willy-nilly refusing people, but I want to make sure it's right for you. That's really my biggest concern of all. And if it is, we'll send you an invitation and we'll allow you to join us for that special intensive 3-month training with 3 months of follow-up question and answer. We hope to take about 5 to 10 years off your training, because if you do this every day, it's going to take a while. The reason we have the Accelerated Market Mastery course is to try to speed that up. God bless, my friends. All the best from the whole team at Charting Wealth World Headquarters.